We are on chapter 4, and in this chapter, we're going to go over the income statement, comprehensive income, which is something you haven't heard of yet. So, we're going to talk about that and statement of cash flows. This is a very long chapter. It's probably going to have several videos that go along with this because it's got a lot of detail. We are kind of hitting that point where the chapters get bigger, lots more information. I kind of mentioned on the first three chapters, those are really just kind of review from your principles 1 and 2. But now we are digging down really a lot deeper. Okay. So just be aware of that. So, all right. So we're going over kind of maybe like two of those financial statements because comprehensive income sort of gets lumped into the income. It's just sometimes how it's presented can be presented a little bit differently. But let's just kind of have a quick review. Remember, we have our income statement is our first one. We have to always have to do the income statement first. Then we do statement of stockholders' equity because we're looking at corporations. Balance sheet, which we talked about in the previous chapter, and then statement of cash flows. Remember, they have to be done in order. If you are given a problem to do all four, do them in order. Okay. So here is an example of the income statement. It's a really big one. It's a lot bigger than what you're used to. So we have these different categories now that we didn't really talk too much about in principles, but right here there's a line here and income from continuing operations. This is a very important number because this is what we can look to repeat in the future. Everything else below is sort of a one-off, one-time thing. So we don't like to throw that into continuing operations because then that tells our users, hey, are you going to be able to do that? Are you going to be able to make money from discontinued operations in the future? Probably not. Okay. Because if you keep discontinuing operations, you're pretty much going to have no business. Okay. So we do have a section here for discontinued operations and then earnings per share. Okay. So I kind of want to go back up here really quick and kind of talk about what is in each one of these statements. So I just showed you the income statement. It is reporting its profit during a particular reporting period. Comprehensive income it used to be everything they didn't know what to do with got dumped in there, but then there was kind of a lot of people were dumping losses in there, but they'd put gains on the income statement. So that kind of be where they parked all their losses just to make net income look really good. But now there's a lot more rules as to what can go into comprehensive income. Okay. These are some things that, like a foreign currency exchange rate, we may have a gain or we may have a loss on it, but we don't want to put that in the income statement yet because it hasn't been realized. Okay. So it's just odd things that get put into comprehensive income. And then the statement of cash flows, which is what I think is one of the most important financial statements ever. Like and I've said this before, if I can only see one financial statement of all four for any company and make decisions on it, I would want the statement of cash flows because the statement of cash flows summarizes the other three all into one. And you can really tell a lot about a company when you can see the statement of cash flows. Okay, so there's our income statement. We have our revenues and our expenses. Okay, revenues, they need to be what we're in the business of doing. You're Walmart, you're in the business of buying and selling stuff. Okay, your expenses is the cost of goods sold that goes along with that. A lot of businesses will be branching out into other areas so much to the point you're thinking they're not really in the original business they were in 20 years ago. Okay. When they started, they've branched off and they've done so many other things. And Walmart is a really good example of that because Walmart has branched off into a lot of different things. I think banking. I think they tried to get their own credit card, like their own like Visa, and I think they were told no because they had their hand in too many pockets. But That was a while ago. I don't really know where Walmart stands on that. They did at one time try to do that, and they said no. The government oversight said no because you just have your hand in too many different things, and then it looks like a monopoly. And we talk about monopolies in legal environment of business, and that's when, one business controls a lot of the market. Okay. So we like competition because competition creates a better product for us, the consumer. Okay. So recognition of expenses, there is a casual relationship between revenues and expenses, and we want to make sure we sort of match that. We talk about matching principle, matching the expenses to the revenues. Okay. So let's kind of start over here. We have is it possible to establish a casual relationship between revenues and expenses? Yes. Then this would be Walmart buying and selling stuff. That's all those things over there. Okay. If it's no, it could relate to an expense to a particular period, or it could be something allocated over several periods or expensed it as incurred. So we can think of those things like depreciation expense for the building. Okay. It's not a direct relationship, not so much like the buying and the selling of the stuff, but Walmart still needed a building. Walmart still needed a warehouse. And so they're going to depreciate that and they're going to allocate it over different periods. Okay. And those are estimates. We don't know if those things are really true. As an accountant, we do the best we can and following the rules of GAAP when we do estimates, but we don't have a crystal ball. We don't know, is that building really going to last us 30 years? Is it really going to have a salvage value of $10,000? We don't really know. So we do the best we can because it's better than to expense it all. If you just think about one building in Walmart, one warehouse, if they decided not to allocate it over so many periods and they just had one big expense in the year they purchased it, what would happen to net income? Net income would plummet, but that's not a really good representation either because that building's going to last us a long time. Okay. So some things are going to get expensed as incurred. They may not have a direct relationship. The Target on University, I think they finally have finished their remodel. They had a big remodel in there, and their bathrooms moved to outside to porta potties, and they were disgusting. I would not use them. And I walked there the other couple of weeks ago, and I was like, oh, they're nice and fixed now. So they redid the bathrooms, they redid things. They may have added that into the asset and then depreciate it, or they might have called it like, some sort of reconstruction or something like that. Depending on the cost, they may have just expensed it. Okay. Let's just say, Walmart goes in and has new floors put down. They may, technically under the rules of GAAP, that would probably count to add to the building, but it might be so nominal that we're just going to be like, no, we're just going to expense it all together. Okay. So we have those direct relationships and then sort of indirect. Okay. So then we have gains and losses from continuing operations. These are the things that you're not going to see every single period. Every single period, Walmart's going to be buying and selling stuff. Okay. They're not going to be buying a new building every single period. Okay. So if they have a gain or loss on selling a building, we don't want that to be in the continuing operations. We want that to be in a separate line, okay? Because that's probably not going to happen every single time, okay? Every single period. Okay, so you can kind of see we're just looking at continuing operations right here. So we have our operating items. We have non-operating items. The most common is interest revenue and interest expense. They had a gain on investment. That would be like if they had bought stock in another company. Okay, so they're really non-operating, but we may see them again. And then we have our taxes. And most of the time in here, I know most of y'all are in individual tax with me right now, or you will be in the future. Most of the time they're not making us calculate a lot of the tax because we know that it's a very complicated formula to calculate tax for financial purposes and then for tax purposes. Okay. So most of the time, I think they're just going to give you like a percentage, take a percentage of that from the continuing operations, or they'll even tell you what the income tax is. Okay. Here is an income statement from the Home Depot. We have our operating. Okay. We have our interest and investment income, interest expense. Those are non-operating. Then we have a provision for income taxes. Okay. Which leads us to net earnings. Okay. We've kind of abandoned the single step income statement, but you still need to understand it. Okay. Remember, single step is just all the revenues, all the expenses. We lose a lot of these numbers in between, like that's operating income. Then net earnings, sorry, let me go back up here. Income before income taxes. Okay. So if you was to take the exact same company, do the single step and the multi-step income statement, you would still get the exact same net income. I believe they might actually do that. Yes, they do. So here's single step, really easy, just all the revenues, all the expenses. So therefore, we're probably not going to do it that much. Okay. Yes, here they give us the multi-step income statement with the exact same data. Okay. We didn't know from this up here, we didn't have that operating income. Okay. Because interest expense got lumped over into um, all the expenses, and we want to sort of separate it out so users of these financial statements can make better decisions. Okay. Then total income, net, sorry, total other income net, and then income before taxes, then our tax expense. Notice our tax expense was just thrown. Oh no, they actually separated it out. But like this number that we got, income before income taxes, it's just we don't really have these intermediate breakdown. Okay. Notice we got the exact same net income as we did on the first one. Okay. So what does multi-step income statement gives us? It gives us a lot more information, not even the operating income, but we get gross profit. Okay. Gross profit is just sales minus cost of goods sold. Okay. Buying and selling stuff, that's it. That's all that's in that number. So here is where you could watch to see if a company is sort of switching. Are they switching to a different type of business? If they end up losing, because if they're in the business of buying, selling stuff, and then they ended up with a negative number here, that would not be good, okay? Because what you're in the business, you're already losing money all the way up here. So how much more could you be losing going all the way down? And if there is still a high net income, maybe there is a lot of other income. So if that's where the majority of our income is coming from every single period, we might question, are they really in the business of buying and selling stuff? Because they got a loss. They're selling everything cheaper than what they paid for it. That's not sustainable over a long period of time. And it may happen in 1 year, 2 years, but not sustainable at all. Most of the time, this is going to be a positive number and it should be a positive number. Okay. We've got operating income. We have the income before taxes, which was 200,000, then net income, or a lot of times they call it the bottom line. Okay. All right. I'm just going to kind of skip on for some of those things. We'll skip these little concept checks. All right. So leading on from that, we're looking at the income statement. We're looking at earnings quality. Okay. Earnings quality. A lot of those things that we're kind of pushing off, into its own section are just temporary. They're not going to happen over and over again. Okay. Permanent earnings are things you can do over and over and over again, and that is where you're going to see your income from continuing operations because that's what they're in the business of doing. Okay. And we're going to talk about cash flows, but if let's just say a McDonald's sells a couple of their buildings and they had a big gain on it. And, for that period, it's going to make the temporary earnings go up. Well, but that's not permanent earnings. Okay. And you look at it as a cash, you want to look for cash coming from operations. You don't want to really see a business generating a lot of cash from selling their long-term assets because if they're selling their long-term assets and it's not just, we're replacing the building with another one, then they're probably having a hard time meeting their short-term li obligations and they can't pay their bills. So they're having to sell things to be able to pull cash in. But that's where the statement of cash flows gives us good information because then we can see they're not generating very much cash from operations. Oh, but they're generating a whole lot of cash from investing, which is your property, plants, and equipment. So that's not good. That's not good quality earnings. An investor is wanting to see that operating cash flows to be much higher. Okay. They're not the one-off things like buying and selling a building, those things happen. You may buy, sell a building, build a new one. A lot of times, a very good, stable company almost just breaks even on that investing. You don't want to see a big positive. You'll see a lot of negatives at the beginning because they're buying a lot of buildings and they're buying assets to be able to set up operations. But if you start seeing a lot of gain off of things like that in that section, that would tell me what's wrong. How are they paying their liabilities? Okay, that would make me want to go and do some liquidity ratios and see how well they're paying their bills as in current or even long term. Okay, so we want earnings quality. Income smoothing is actually a bad word. We don't like that in accounting. We don't like that term because you will get managers who will tend to like smooth some of these, and you can kind of tell by this graph, they kind of just took earnings and smoothed them out rather than giving us the actual data that was happening, the up and down. You'll see managers do things like this. They'll try to, you know, if you had a high income one year, they might want to make it lower so that it looks like you did a whole lot. A lot of this times this happens when new management comes in and they're like, hey, you know what? Their bonus plan might be based on earnings per share. So they may come in that first year and they may take a lot of hits, write down a whole lot of things to make it look really bad, make the net income look really bad so that it looks good in the coming years. So we don't like income smoothing. We don't like that. Okay. We don't want management coming in and trying to smooth that out. That is not anything that we like. We want to have good data, whether there is mountains and valleys, we don't care. We want to see those mountain and valleys. We do not. And if you ever come across management who is trying to do income smoothing, there's only so much you can do within GAAP as long as they're following the rules of GAAP. But if you see that, that is a huge thing that we do not like. They can classify things a little differently. That's exactly what WorldCom did. It was through a lot of journal entries, but ultimately took expenses and made them back into assets, took it through a whole bunch of journal entries, but that's ultimately what they were doing was reclassifying expenses. Okay, to make income look better. Okay. All right. I am going to stop there for this video and we will pick up in the next one.